So then, Adam, if the 10-year and the 30-year are more so about inflation, the five-year is more about growth. What is the strategy here then, given the volatility that we're still seeing?
I think for just at a high level for investors, they should consider locking in some of these interest rates. We're talking, yields at 5% for risk-free assets. I think it looks like an attractive time when you compare stocks to bonds. That equity risk premium is at historically low levels. So I think at a high level, again, I think it's an attractive time to lock in some of these yields. You don't have to take a lot of duration risk, meaning you don't have to go further out on the curve to capture those attractive yields. You also don't have to go into the high yield space. The corporate or investment grade corporates on the short side for high quality still look pretty attractive to us. And then when you think about inflation in terms of driving yields higher, on the long end, it's really been about above the economy coming in better than expected. If you look at break-even rates, they've actually deteriorated or come in a little bit. So it's really just this resiliency theme that we've seen in the economy driving that higher for longer messaging from the Fed.
What does the broader context look like, Adam? I mean, if we do see the 10-year break above that 5% level and remain there, what does that ultimately mean for the average American?
I think it's going to be higher borrowing costs. The lingering effects of the tightening are certainly playing into that as well. We're still, talking about another potential rate hike from the Fed. We've seen the 2-year that's more sensitive to the monetary policy already breaking out. So I think that's a little bit of a warning sign. And you can see just how that's impacted some of the consumer discretionary names as well, starting to pull back a little bit more significantly in those names. Of course, rising energy costs are influencing that as well. Big picture, though, I think for the S&P 500, as long as the 10-year continues to trend higher, I think it's going to be a struggle for upside momentum to continue for stocks.
And so I know that you've noted some of the sectors that you like in your notes here. At what point does that change, though?
For now, we think these are durable trends with shelf life. We like energy as one of our favorite ideas, for example. Crude oil continues to work after recently resetting from overbought levels. Natural gas is trending higher as well. We like the supply and demand dynamics. And this is before what's transpired in the Middle East. This is also without really a lot of support from China. That's been an underwhelming area in terms of the economy. And crude oil continues to work, and it's really just those supply and demand dynamics playing out. We have very low supply in the US, production is picking up, but I think that's going to help the overall energy sector. You get high free cash flow yields there, attractive dividends, and broad-based breadth when you look at the energy sector from more of a technical lens.
LPL Financial Chief Technical Strategist Adam Turnquist, good to talk to you today.
Thanks for having me.